Equities have become more volatile, oil has collapsed, and trade war tensions are ramping up. So what are these forces shaping 2019 to be like? Joining me now is Erik Norland. He's the senior economist over at the CME Group. Erik, thank you so much for joining us today.
Hi, Daniela. Thank you for having me back.
Erik, let's start with the macro landscape here. How would you describe data in the US? Are we seeing bullish or bearish signals here?
So it's a difficult question to answer because in general, 2018 was a very, very strong year for the US economy with about 3% economic growth. But I think what's worrisome now, especially for metals markets, is that late in the year we started to see a lot of very soft data, particularly with respect to the US housing market. We saw price declines in a number of markets and a lot of softness in housing starts and building permit data. So I think that that's maybe sending not such a strong signal as we go into 2019.
The yield curve is now negative for the first time since the recession. Are we going to see the R word anytime soon?
So there's been a lot of press attention about the so-called inversion of the yield curve. And so there's some truth to this. We've seen an inversion between about the 1-year and the 5-year point of the US yield curve, which has become extremely flat. But I think it's important to point out that the overall yield curve between 3 months and 30 years still has about 75 basis points of positive slope. So this is not pointing to a recession in 2019, but it may be pointing towards a significantly slower economic growth. So perhaps 1.5% growth rather than 3% growth that we had in 2018.
So with this all in mind, how should investors allocate their assets? How can they protect themselves?
So the question of asset allocation is a very, very difficult one. I think for most investors, the best allocation is one with a great deal of diversification. We may be getting into the late stages of an economic expansion. I don't think that that expansion is over. The late stages of an economic expansion can be very treacherous, particularly for equity investors. Often the equity market continues to go higher in the late stages of an expansion, but it often does so in an increasingly volatile fashion with big corrections like we saw between 1997 and the eventual peak in 2000, for example. So I think it's a difficult question to answer, but I think that a portfolio that includes equities, fixed income, as well as certain commodities such as gold might be more resistant to this sort of economic environment than one that's very concentrated in just one asset class.
And how will gold respond to this outlook, Erik? Can we see a flight to safety in 2019?
So with respect to flight to safeties, gold does particularly well in flight to safeties in which inflation is the main concern. So if we see the labor market continuing to over-tighten with unemployment rates falling even further, when we see some upside pressure on inflation, that could be extremely bullish for gold. On the other hand, a significant slowdown in U.S. economic activity could be more complicated for gold. So on the one hand, it's not inflationary, which is not great news for gold. On the other hand, it could take a lot of upward pressure off of interest rates, which could be bullish for gold. But the main thing to watch out for gold is the US dollar. Gold has been showing an extremely strong negative correlation with the US dollar of around negative 0.6 during the last year. So if the US economy slows down in a way that weakens the US currency, that could be very, very bullish for gold.
So if I asked you to choose among the commodity space here, which one will be the best performer in 2019? Is it energy, base metals, precious metals?
So that's a difficult question. You could make a case for any of those asset classes performing well or poorly in 2019. With respect to energy, I think the real key here is going to be geopolitical risk. The economics of energy, I think, remain pretty bearish. U.S. production is soaring. It rose 2 million barrels per day last year. With a 2 million barrel per day increase year on year, that could replace OPEC's recent 1.2 million barrel per day cut in the span of just about 6 or 7 months. So for energy prices to continue to rally, I think you need to see a lot of geopolitical risk. For base metals, the key is China. If China continues to grow at a fast pace, that could be bullish for copper and for other industrial metals. But if China were to slow down significantly as a result of the trade war, their massive accumulation of debt, that could be quite bearish. And then once again, for precious metals, the real key is going to be the strength or the weakness of the US dollar. If the US dollar turns out to be a weak currency in 2019, watch for gold to potentially rally quite significantly.
All right, Erik, thank you so much for joining us for this special Outlook series.
Thank you so much, Daniela, for having me back.
Thank you, and thank you for watching. We'll have much more for you, so be sure to stay tuned.